bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the May 27th, 2025 episode, and we're recording this on the morning of May 27th in the West Coast. It's an early afternoon on the East Coast. I do hope that you had a great Memorial Day weekend. My guest this week is Novogradac's Chief Public Policy Officer, Peter Lawrence. Peter is here to talk about reconciliation legislation that's in Congress. This is a subject that affects nearly everyone involved in affordable housing, community development, historic preservation, and clean energy. Many of you joined us at our Renewable Energy Tax Credit Conference in Chicago a few weeks ago. And during that session, our Wash and Wire session, I mentioned that we'd be having this upcoming podcast so that those that were in attendance 2 weeks ago could get an update on what has changed. And boy, have things changed with respect to clean energy, and not in a good way. I also mentioned last week at American Bar Association's Affordable Housing and Community Development Conference that Peter would be back on this week in order to give the most recent update. And last week, we were waiting to see what was happening with the House and whether the House could pass the reconciliation tax and spending bill. Now, as we're recording this afternoon for Peter, the House has passed a reconciliation bill, and the Senate is now preparing to take it up next week. This week, the Senate and the House are in recess. So what's the focus of today's podcast? Well, specifically, we're going to talk first about what's in the bill as it relates to community development and renewable energy. We're also going to discuss what's not in the bill with respect to those items, but more importantly, could be added in the Senate. We're also going to discuss what to expect timeline-wise. As many of you know, Peter has unique insights from his position in Washington, and there's plenty we have to talk about. So with that, if you're ready, let's get started. Peter, welcome back to Tax Credit Tuesday. This is your 21st appearance as a guest. After this, you cannot take another card or else you'll bust. But I do want you back.
Bust to present the latest information on what's going on here in DC.
Yeah. You being a guest is never a bust. But with that said, you have been a guest, as I mentioned, 20 times already. Please remind our audience, nonetheless, about some of the services that you provide to Novogradac clients.
Happy to do so, Mike. You know, we here at the Novogradac Public Policy Department have a variety of engagements that we've done to help you out with any problem you may have with any tax incentive regulation guidance issue. And we also help address and develop legislative proposals for you. If you have an idea on how to create a new tool to help affordable housing, community development, historic preservation, or renewable energy, we're more than happy to work with you on developing those tools as well. So we hope that you'll consider us if you ever need some assistance in dealing with Congress administration.
Great. Thank you for that, Peter. And as our audience knows, you serve as policy advisor for all of our various working groups. So I'd encourage our audience to join one or more of our working groups if they aren't already. Now, before we dive into the particulars of the tax bill, Peter, please level set for the audience where we are with respect to the legislation. I mentioned in the intro, it's passed out of the House. It's now in the Senate. Give some of your perspective on what that means in terms of ultimate passage of a partisan tax bill.
Happy to do so, Mike. And, you know, in some respects, you could think of this as we're a third of the way through. Not necessarily in the time, but in the process, in that the two more significant steps that are left to go is the Senate needs to pass its version, where we do definitely expect there to be changes. And they're going to have to reconcile that again with the House, which if there are changes, the House are going to need to approve any of those changes. So there's those two very important steps. But last week was a huge, milestone for this legislation, and frankly for the Trump administration's domestic priorities. This is the One Big Beautiful Bill Act. That's actually the official title. It's not just a little catchphrase. It is a very, very significant piece of legislation for this administration and this Congress. And how we got here, of course, is this is a reconciliation bill. And when it comes to a reconciliation bill process, there's two steps. There's first the step to pass a budget resolution that includes reconciliation instructions. And shortly before the Easter recess on April 10th, the House did pass a final version of that budget resolution, which unlocked this process to go forward. And through the course, after they returned from the Easter recess, each of the House committees, including the Ways and Means Committee, acted on its portion of the reconciliation bill. Those were all stitched together by the House Budget Committee and then sent the full House for consideration, and it passed by the narrowest of margins, Mike, 215 to 214, which really underscores the very delicate high wire balancing acts that House Speaker Mike Johnson's needed to do on this legislation, and that too many changes that could upset the apple cart and potentially, lead to a situation where we don't have enacted legislation. But
I can actually interject there on the 215 to 214, because I found that fascinating. And maybe it's just because I'm an accountant and I want to count the numbers, and I gravitate there. But as you know, we're discussing kind of going into that vote, there are 220 Republican votes available theoretically, and 212 Democratic votes available, because there's 3 seats that were held by Democrats that are now vacant and will be filled within the next few months. So it's 220 to 212. And you mentioned the Republicans lost 5 of those votes of the 220 down to 215. And of those 5 they didn't get, 2 voted with the Democrats, hence you were 215 and 214. And then there were 3 votes. 1 voted present. And then there were 2 others that didn't vote, but have said that they would have gone to vote. I believe they both said they would have voted for the bill. So that would have made it 217 to 214, which would have meant they could have lost 1 more vote. And I just think once the bill has to be voted on again in the House, it'll be interesting to see, how many votes against the bill there are versus how many votes present among that limited cushion, to see what ends up happening in terms of being able to get it through the House. But anyways, enough on the number side. Please continue now that you pointed out how it was narrowly passed in the House.
Yeah, it was quite a challenge that Speaker Johnson pulled off. We all have been saying it's going to be terribly challenging given that very tight margin you described, Mike. But so far he's been able to pull it off with a significant assist from President Trump to help lean on certain House Republicans who didn't like the legislation from one perspective or another. But it has gotten through. And I think the pressure is now on for the Senate. And I do think, they do have a bit of a better cushion in the Senate. There's also a 3-vote margin, but 3 votes out of 100 rather than, the margin that you had described in the House. Senate Majority John Thune, Republican from South Dakota, has more room to go in finding a pathway to a majority in the Senate. And I do think he has a decent chance of finding a way to get the bill through the Senate. But it's going to be still a challenge there too, in that you still have, I think, various factions amongst the Senate Republican conference that dislike certain aspects of the bill, and it will. There will definitely be changes, but exactly how Leader Thune balances those will be interesting to see.
No, I agree. And then once it makes its way adjusted through the Senate, that's, you were saying, a third of the process getting it to the Senate. Once the Senate passes a bill, assuming they do, I'm going to assume that's the next third.
Yeah.
And maybe describe for our audience what the final third is. And we're going to ignore the president signing the bill because we're going to assume once the Senate and House come together, the president will sign the bill.
The last part of the process, really, there's two main options. There can be what's a formal House Senate conference, and that's when both the House and Senate vote to appoint members to a special sort of what they call a conference committee, and conference committee hashes out the differences between the two bills and suggests here's the final version of the legislation together. That bill then has to, of course, pass the House and Senate together. And that has been used. In fact, actually, if you look back in 2017, the Tax Cuts and Jobs Act, that's what actually did happen. The House and Senate had two different versions of the legislation, which the House, remember, for those who have PTSD about it, had certainly a significant impact on the community development tax incentives. The Senate had a much better version for community development. They hashed out those differences in a conference committee and voted upon, and it passed and was enacted and signed by President Trump in his first term. What we're hearing so far is it doesn't seem likely that they'll employ that process. Instead, they'll have what's called the informal conference, and that means basically the leadership of the House kind of communicates to leadership of the Senate and says, okay, we're okay with this change you make. We're not okay with this change you're thinking of making to legislation. So that when the Senate is considering its various changes, it does that with input from House. And therefore, when the Senate finally votes on the final version of theirs, it has, in essence, kind of incorporated some, feedback from the House, such that there's a decent chance that when it goes back to the House, it will actually pass. And that will sort of save time, because the ultimate goal here that both the House and Senate leadership has is to try to get a bill to the president's desk before the 4th of July. That's still pretty ambitious, given all the various steps in the process. We haven't talked about the Byrd rule yet, but that takes up a fair amount of time, that process. And so it will be very challenging to try to meet that 4th of July deadline. And in fact, I would say it's probably more realistic that maybe you have a final Senate bill before the 4th of July, and that when they come back, that's when they essentially, the House would take up that Senate passed legislation in anticipation of having a final bill done before they leave for the August recess on August 1st. That of course remains to see. That certainly, we don't know yet what the timing is like, but that's what I would guess.
So thank you for that. I agree with you in terms of the July 4th being an aggressive timeline. And sometimes clients will come to me and say, how do I even know they're going to do anything? Could this just drag on until December? And there's a key aspect that'll keep it from dragging on until December. If they're going to get something done, it has to get done before sometime in August. Please explain to our audience why.
Yes, the one thing that's in the reconciliation bill that's key to the timing is a provision increase the debt limit. For those who may not be aware, the debt limit was suspended until January 1st. And ever since date, Treasury has been using what it's called extraordinary measures to avoid breaching the debt limit. And so far, we've been, of course, waiting to hear over the weeks for updates on when the so-called X date, that's the date at which Treasury can no longer use those extraordinary measures to avoid a debt limit breach and still keep meeting all the various obligations for the federal government. And recently, Treasury Secretary Bessent did inform Congress that his estimate of the X date would be sometime in mid-July. And so he urged Congress to take up the reconciliation bill and pass it before that. And we'll see if that date changes as we get closer. I mean, that was the last update was based on the revenues that came in for the April 15th individual tax filing deadline. I'm sure they'll continue to update as revenue comes in and various spending obligations are also met. And we'll see if there's a more refined update. But I think that's what's really driving. Congress definitely does not want to have an unprecedented U.S. default on our debt obligations. That would really cause a lot of economic turmoil. And so that is really the action forcing event to get Congress to act on the reconciliation bill. And so we'll see. Now that it is possible, I do want to just note that they could decide to peel off the debt limit issue from the reconciliation if they are sort of having trouble on the reconciliation bill, but leadership does not want to do that. They want to use the debt limit as a means to push forward. And right now I have no indication that they're at all thinking of peeling it off. But I think in the end, that's what they're trying to use to make sure that this legislation gets done by the deadline they want to get done by.
Thank you for that. And I appreciate you pointing out the potentially peeling it off. In the course of our discussion, we're sort of implying that the House and the Senate will come together on a partisan basis to pass a tax and spending reconciliation bill, and that the president will sign it. And as you were mentioning, we think it'll happen before the debt ceiling will expire or be breached beyond the extraordinary measures. But failure certainly is an option here. And there's a whole other set of whole other podcasts we could have if we were going to go down that path. But for now, we'll stay focused on what I think most of our audience probably believes is they'll find a way to sort of come together before the debt ceiling date. So with that, let's now focus on what is in the bill and what's not in the bill. And we'll start with what's in the bill. And in terms of what's in the bill, there's a couple of positives in the bill and a pretty dramatic negative from the perspective of our clients. And more broadly, when I say about positives and negatives, we at Novogradac work in affordable housing, community development, which can include new markets and opportunity zones. We work in the area of historic preservation and obviously a very substantial clean and renewable energy practice, among a number of other areas. And within that milieu, if you will, the bill does include provisions that provide for opportunity zones, renewal, for expansion of the local housing tax credit, and paring back clean energy. So I wanted to first, Peter, and we can go through these somewhat sort of briefly, and we'll have lots of references in our show notes to the various blog posts that you've written and other resources to learn more of the details about what is in the bill. But let's start with opportunity zones. The House passed bill does have a renewal and updating of opportunity zones. Please give a brief overview to our audience as to what made its way in as relates to opportunity zones in the House bill.
Happy to do so, Mike. And just before I go talk about it, I do want to just emphasize one thing, and that is, if we go back, remember within history, for 8 years ago when the Tax Cuts and Jobs Act was which was the legislation that created the opportunity zone incentive, the House version of the bill did not include anything on opportunity zones. So I think one reason why we see it being a positive that the House does include opportunity zones provisions is that demonstrates how much farther we've gone from 8 years ago when there wasn't any provisions. But that being said, I think folks were a little surprised at the extent of what was included in the opportunity zones. One of the key um, uh, objectives is to get a new round of opportunity zone designations, and this legislation definitely does include that. However, it does have a narrowing of the geography in that instead of being able to designate low-income communities with an area median income of 80% of the area for that census tract, uh, now that is narrowed to 70%, while at the same time, the limit on the amount percentage of zones that a governor can designate in a particular state is still at 25%. So that is a little bit of a surprise that the scope, geography is narrowed in this legislation. Not only that, there is also a significant emphasis on rural areas. There needs to be a certain minimum percentage of opportunity zone designated than in rural areas. And so I'm not going to go over those specific details on this podcast, but encourage folks to follow up with us if you're interested to do that. There's also, it does allow for, in that new round, a new deferral of taxes for investments that are made after 2026 until the end of 2033. There's also a 10% basis, just like in the first round, for 5 years, investments held 5 years in non-rural areas, and it could be as high as 30% basis step up for investments in rural areas held for 5 years. In rural opportunity zones, also there is a lowering of the substantial improvement threshold from 100% of basis to 50% of basis, and sort of a new feature in the opportunity zone incentive would be to allow up to $10,000 in ordinary income to be invested. This is, I think, an attempt to try to democratize access of the incentive to folks who don't necessarily have capital gains income. And last, I'll just say there's a request to have reporting requirements, which were included in the original legislation that authorized opportunity zones, but were stripped out as part of the budget reconciliation process 8 years ago. And that scenario may be revisited when the bill it heads over to the Senate as part of the Berg roll evaluation.
And that, as you know, the strip out occurred because the part of the Byrd rule dealing with budget reconciliation, which is really a Senate concept, so that the Senate can pass the bill on a partisan basis and only need 50 votes plus the vice president to pass the bill, as opposed to needing 60 to eliminate a filibuster. And that under this reconciliation process, a provision has to have a revenue effect that's not incidental to its policy, and reporting doesn't have a revenue effect. So it as designed in the House, so under the Byrd rule, it would likely be pulled out at the Senate unless the Democrats chose not to challenge that rule as part of the Byrd rule. And that's also why the Tax Cut and Jobs Act isn't actually technically the Tax Cut and Jobs Act, because under the Byrd rule, calling it the Tax Cut and Jobs Act, it didn't have a revenue effect, just like this big, beautiful bill technically probably would not be called the big, beautiful bill because of the Byrd rule, but that's some of the crazy machinations that happen. I just wanted to maybe note beyond your sort of summary here of what was sort of in the bill, that the bill would provide that the existing zones would expire at the end of 2026. And, that's kind of obviously a big deal, as of they're going to expire at the end of 2028. And our Opportunity Zones Working Group is actually meeting later today, and I'd encourage folks to become members of that. And now one of the critical questions is, if the zones were to expire at the end of 2026, what impact does that have on existing investments and existing planned investments. And it's something that we hope the Senate will change. So it'll just be an exercise in futility because we won't end up having to worry about the zones actually expiring in 2026. But that is a big deal. And I myself don't understand the Joint Committee on Taxation scoring of the opportunity zones piece. And I totally respect all the work that they do and the challenging they have trying to estimate the cost of various provisions and all the rest and doing it under tight time pressures and the rest. But most in the opportunity zone space think that if the zones did expire in 2026, there'll be a decrease and a substantial decrease in the amount of capital raised for opportunity zones over the next few years until the new zones are available sometime in 2027. So the scoring, if the JCT is going to score this, they probably should be taking into account what the market responses will be if they were to make the changes that were in the House bill, which I recognize is a challenge. And I'd also just say more generally, those in the opportunity zone space, as you noted, we're excited to see something in the House bill coming over to the Senate. However, most in the space were looking to go from 1.0 to 2.0, and many think of it as going from 1.0 to 0.7, because as you noted, there'd be 30% fewer zones just to start with. So it is something that there's a lot of hope and somewhat expectation that the Senate will move the bill to be much more positive and much more expansive and more of a modernization of opportunity zones as opposed to a slight paring back in greater targeting. So,
Indeed, Senator Tim Scott, we know that this is a huge priority for him, and I would be surprised if his number one ask when the bill comes before the Senate is to make significant changes to the opportunity zone section. So I am fairly confident there will definitely be significant changes when this bill comes to the Senate.
So let's now turn to the significant provisions concerning affordable housing. And, the affordable housing community is very pleased with the House bill and the changes it made. And the lead sponsor for the legislation to expand the loan for the tax credit in the House, Representative LaHood, did speak at our affordable housing conference the Friday before the bill came out, and he was optimistic about getting some expansion of the loan for the tax credit as part of the bill, and his optimism was justified. So we appreciate him joining us and appreciate all the work he's done along with so many others. Please describe for our audience the three key provisions or three key areas whereby there'd be more resources available for the financing of affordable housing under the House bill.
Yes, it's a tremendous victory, Mike. And I have to say, we were pleasantly surprised, given that we knew it was going to be very challenging to get tax provisions into this legislation that weren't sort of part of two main buckets, right? There was the bucket of extensions of the Tax Cuts and Jobs Act provisions, which were expiring at the end of this year. We knew that was a huge priority of President Trump and the Republican-led Congress. And then secondly, the second bucket being a number of President Trump's campaign tax promises. We knew that was a huge priority that Congress was going to incorporate in the legislation. And after accounting for those two, we weren't sure how much space there was going to be in this legislation for other things. And so when we saw the legislation came out, it had included those low-income housing tax provisions. We were very, very pleased. This will likely be the largest expansion resources and for at least 25 years, perhaps arguably for even longer, if it were to be enacted. So this is I would describe the provisions being one, of course, the lowering of the 50% private activity bond financed by test to 25%, which is a key proposal of the Affordable Housing Credit Improvement Act, which is the long-standing affordable housing industry legislation has been pending in Congress for several years now. And we, as part of our analysis, Mike, estimated that if the 25% test were to be made permanent, that would finance over 1.1 million affordable rental homes over a decade. Now, what was included in the legislation, given the constraints that we had, was a 4-year provision. In fact, all of the low-income housing tax credit provisions were 4-year provisions. So for you need to have your property financed by bonds issued after 2025 and before 2030, i.e. 2026, 27, 28, and 29, in order to be to qualify. But I do also want to point out that the legislation specifically separates the acquisition rehab position. So you could theoretically have a property that was acquired in 2025, but the rehab work was financed in 2026, and they could still get the 25% test on the rehab portion of that property. And so that's a very significant win for us all, and very promising that it was included. There's also a restoration of the 12.5% increase in 9% allocations that had expired in 2021. That is also reinstated for 26, 27, 28, 29. And then the last category is you could consider it two separate provisions, Mike, but they are essentially operate similarly in that it provides a basis boost for properties that are in rural areas or in tribal areas. And that rural areas are defined as non-metropolitan counties or areas that are defined as rural under Section 520 of the Housing Act of 1949. That is the definition is used for the U.S. Department of Agriculture's rural housing programs. And I do want to point out, the legislation does say, and those areas need to be included in the QAP, but it is our understanding that most states would endeavor to include any area that qualifies under Section 520. And they're still, of course, subject to the financial feasibility test. Need the for the boost in order to be financially feasible. But I don't think that will be a challenge for many rural properties, especially if you're financed by bonds. There'll still likely be a need for that additional equity. So those are tremendous set of proposals. All told, we here at Novogradac have estimated that it would just in that 4-year period of time that would finance nearly 528,000 affordable rental homes. So a great down payment on the promise of the if those provisions were made permanent, which if you add them all together from the Affordable Housing Credit Improvement Act, we estimated that nearly 1.6 million affordable rental homes could be financed. So really amazing package of proposals, and I think we feel reasonably confident that they will remain unchanged when it goes and is considered in the Senate.
Yeah, thanks for all of that. And I would encourage state agencies to be reaching out to our colleague, Mark Shelburne, as they're thinking about how the transition rules might work and how the prospects of this legislation might affect their activities for the balance of this year, as well as next year, and all the various issues that you mentioned to get in a position to capitalize on these changes and generate as much affordable housing financing in their particular state or jurisdiction. So I would encourage folks to reach out to Mark Shelburne. And then also, if you're a developer or investor and the like, and you're more interested in some of the transition rules on the 50% test or the basis boost and the like, I'd also encourage you to reach out to your Novogradac professional and or reach out to Dirk Wallace. That's certainly something that'll be a topic of our various monthly tax credit working group sessions, monthly sessions over the next few months, and probably into next year as there'll be new developments, I'm sure, continuously. So those are the good news. I'd say sort of good news for opportunity zones, great news for affordable rental housing. Now let's turn to the not so good news, or bad news, I should say. It's not even not so good news, it's bad news. And that's clean and renewable energy. And here, Peter, we could do a whole podcast on the various changes. So I want you not to go into super detail of these various areas, in part because the House bill coming out of committee was bad for renewable energy with phase outs and sunsetting and the like. It got worse before it was passed by the House as a whole with some manager amendment changes. We expect there to be notable changes to these various provisions in the Senate. So with that background and that guidance, if you could describe at a high level some of the key changes to renewable and clean energy. And as with the various working groups we do have a renewable energy task force working group that's very focused on trying to address these various changes and how they are impacting business today, as well as over the next 12 to 24 months. Take it away, Peter.
Thank you, Mike. And yes, as you point out, we could definitely do a standalone podcast just on this piece. So I'll just try to distill it to four main buckets of changes. One is, and we knew this was likely to happen, this was telegraphed for several weeks and months in advance of legislation being released prior to the Ways and Means Committee consideration of the reconciliation bill. But all the various electric vehicle related tax incentives, sections 30D, 45W, 30C, and 25E, which I'm not going to go into details, but those are all essentially new, used, commercial, and electric car charging incentives. Those were all proposed to be sunsetted by the end of this year, and I think of this particular set, I don't think likely be changed, if at all, by the Senate, given that we know that was very much a target as part of this legislative process. The next sort of bucket, I would say, are the various housing-related energy incentives, including Section 25C, Section 25D, and Section 45L, the latter of which is often used in low-income housing tax credit proposals. Those are also proposed to be sunsetted at the end of this year. The clean hydrogen production credit, Section 45B, that's also proposed to be sunsetted. And we'll see about those latter two components of the sunset in 2025, whether the Senate might change it. It's possible. We'll see. They're going to be under challenges not to make too many changes for fear of upsetting the apple cart in House. But we'll see if that ends up being altered, comes to the Senate. The next sort of bucket is the foreign entity of concern language. And we have known for a little while that congressional Republicans wanted to make sure that efforts were taken to truly tighten the supply chain and ensure that the various elements of renewable energy and clean energy facilities do not include pieces that are originate from the four main countries of concern, being China, Russia, North Korea, and Iran. And given how extensive the supply chain is in China, we knew that was going to be a challenge. But as the language currently drafted, and I'm not going to go into the detail about specifics here, but there is a large consensus in the industry that they're very, very restrictive, almost to the point where it's not clear how one could comply with it with any certainty. And so there's a lot. I do think there's going to be a significant effort in trying to make those elements more workable, and I imagine the Senate will make changes in that section. There is a phase down proposed, although the phase down, I don't know how relevant it is based on this last change in the House passed bill, where facilities essentially need to commence construction within 60 days of the enactment of the bill. That's that sort of last minute change surprised many, and really, I think, made the phase down not as effectual as we thought it might be when it first was released. The bill was first released in the Ways and Means Committee. But that's we expect there will be some form of phase down when the Senate considers this portion of legislation.
And this phase down of the investment tax credit and the production tax credit.
Yeah, starting to make that clear. Yes, both. And that's the tech neutral version, section 45Y and section 48E, Cat E. And so that is, we definitely expect there will be some form of the phase down, but how it was drafted by the House is likely to change in the Senate. And then the last bucket is on transferability, where the House bill does allow for the transferability to occur, but given how stringent the commence construction provisions are, we imagine there'll be changes when it comes to the Senate as well.
Great. Thank you for that overview. And I'm sure I'll have you back once we get through a Senate bill. I'm not sure if we'll bring you back once the Senate bill's done, assuming it gets done, or after the House and the Senate agree on a bill. But we'll talk about that in the future to go into some of these provisions in more detail. I did want to just note for the audience that bonus depreciation, which is really 100% expensing for personal property and land improvements, is in the bill for 4 years. I will note that, it's retroactive to January 20th of this year in the bill, which not so coincidentally is the inauguration date of President Trump, but there is a binding contract or a binding commitment limit such that if you've committed to buy property as of that date, you're not eligible for expensing. So we'll have to see if that changes in the Senate or not. Otherwise, it might limit the ability to use expensing for a lot of affordable rental housing, property placed in service this year, more to come. And the interest expense deduction limitation, commonly known as 163J, that there is a provision to adjust that going forward. I'll also note there was no corporate tax rate cut. There was no changes to the taxes, that the ability to use productivity bonds to finance residential rental housing. And we have talked before on the podcast about the potential for a corporate level limitation on state and or local taxes. That was not in the House bill, which is not to say it couldn't make its way into the Senate bill. So those are some of the key provisions that weren't, that are in the bill that are helpful or were not in the bill. Many would have viewed as harmful. With that said, anything else on the bill you wanted to mention, Peter, or should we jump to the areas where us in the community development community were hoping to see provisions that were not in the bill?
Just very, very quickly, Mike, in the sort of the energy realm, the long-term communities bonus, the annual 1.8 gigawatts that's available, was somewhat surprisingly not touched. It was certainly subject to the same phase down in various other components of the legislation, but that still could apply. So those of you who did apply for the 2025 round early this year, they still should be available, and we'll see as the legislation develops if there are any further changes on that. Domestic content bonus is still there, although given the foreign entity concern, it's that's probably a more stringent issue there, but they definitely didn't target that. And energy communities still are also that bonus is still available. Subject to the same potential phase down. So I think that was the only thing I wanted to add on that front there, Mike.
Okay, thank you for that. Please share with our audience some of the provisions that we were hoping to see included in the House bill, or we hope to see eventually included in a reconciliation bill that are not in the House bill.
Well, first and foremost, Mike, of course, is an extension of the new markets tax credit. For those who may recall, of course, that we are in the context of a 5-year extension that was enacted by President Trump during his first administration. And it does expire. We had hoped that it would be included in the reconciliation bill. As you know, as you mentioned earlier, we do have House Ways and Means Committee Chairman Jason Smith keynoting our New Markets Conference next week. And he is an original lead sponsor of extending new markets. So we know he's a big supporter. So this is a little bit of a surprise. But I think there's definite hope that when the Senate weighs in, that it will include an extension of new markets. If not necessarily permits, maybe that's possible too. We'll see. It all depends on how a variety of other aspects of the legislation are considered. We don't have time to go into great detail, but I think certainly we're going to push to make sure that there's something to extend new markets credit, given that it's been an extraordinarily successul incentive, and it does expire the year, and there's not a good chance after this legislation is considered, if there is a reconciliation bill that is enacted, the chances of another tax bill are, I think, go down quite considerably, given the major tax to-dos will be addressed. And so I think that's why we're really prioritizing making sure that you get into this legislation, not have to wait till the next one. The other aspect in community development is something on the historic tax credit. Just as a quick reminder, the Tax Cuts and Jobs Act did change the historic credit from a 1-year credit to a 5-year credit. And so there is a nexus there. One could argue that as part of the Tax Cuts and Jobs Act bucket of provisions. And we know that Senator Bill Cassidy, a senior member of the Senate Finance Committee, is going to prioritize historic provisions when he has his opportunity to make changes to that part of the reconciliation bill. And there are a number of other provisions in the legislation he leads, the Historic Tax Credit Growth and Opportunity Act, that may be possible, and we'll see how that process goes on, goes forward. And then the other sort of housing tax related bill we thought had a decent chance of getting in was the Neighborhood Homes Investment Tax Credit, which really borrows from both the low income housing tax credit and new markets to provide a tax incentive for the development of single family owner occupied housing, especially in distressed communities. And we know there's a wide recognition in Congress about the need to address the lack of affordable housing supply. And the fantastic provisions on the housing credit just clearly demonstrate how the Congress is addressing it on the rental side. We thought there might be a similar effort on the owner occupied side. And unfortunately, I was not able to get in. And that as a new incentive, I think it was going to be much, much harder than it would be for the housing credit, new markets or historics. And Senator Todd Young, who leads also on the low-income housing tax credit, does lead on neighborhood homes, and we'll see how hard he pushes to try to get a version of that included on the Senate side. But it will be challenging, I think, that. And then lastly, there are a couple of other tax related items we thought had an outside chance of getting in. There was a bill to provide $15 billion in tax credits to convert office properties into affordable housing. that had a decent level of support, but did not necessarily get in. There's the workforce housing tax credit, which essentially would provide a separate pool of tax credits, very like the low-income housing tax credit, to address a household earning up to 100% of the area median income. And so that is something that the Senate Finance Finance Committee ranking member Ron Wyden has been leader on for many, many years. And so while it's great to have that level of support, he's sort of mostly on the outside looking in as a Democrat, given this is a partisan driven process. And so it's not terribly surprising that might not make it in as a result. And then lastly, there is a new proposal that we anticipate will be introduced in the House soon that would create a new incentive for the preservation of rental housing, and by trying to provide an opportunity to syndicate tax losses. And we know that preservation is an increasingly challenging need that the nation is going to confront as housing credit properties come to year 15 and year 30, as well as many other federally assisted rental housing. Their contracts are expiring, et cetera. And so we know preservation is going to be an ever-growing need. And I think we need more financing tools, and this is going to be one that's going to be introduced soon in the House, become part of the conversation for tax legislation in the future.
Thank you for that. I mean, I will kind of build off of what you intimated, which is Chairman Jason Smith, Chairman of the Ways and Means Committee, has been talking about the potential for a year-end bipartisan tax bill, which some of these provisions that don't make its way into the Senate, into the final bill that passes over the next few months, would be candidates to be included in any sort of bipartisan tax bill that Chairman Smith has been talking about. And I'm excited that he'll be joining us again at our New Market Tax Credit Conference next week, because it'll be interesting to get his perspective on that. There's definitely a large number of folks who believe that the chances of getting a bipartisan tax bill at the end of the year after doing a partisan tax bill isn't very likely. But Chairman Smith knows a lot more about this than I do, so I'll be interested to hear what he has to say and what he thinks the possibilities are. Obviously, everyone who's working in these various areas want to get into this bill. This train is apparently going to be leaving the station, and you want to catch a ride on it to be certain. So let's turn now to the Senate approach. We've talked about the fact that the Senate is more likely to roll back some of the renewable energy tax credit cutbacks. Not that they're going to eliminate the cutback, but they'll delay them and not make them as severe and as sharp. And we talked about foreign entity of concern, making those more practical and more operable, as well as not having the tech neutral energy credits phase out quite as quickly and as restrictively, and some of the other changes to renewables. We're also expecting some of the other cuts, maybe most notably Medicaid, to maybe not be as severe as coming out of the House, and the potential to add back new market tax credits, historic tax credit provisions. Maybe it's going back from a 5 to a 1 year credit, maybe a base adjustment for both, other sort of changes there. All those end up causing the bill to cost more on net. Tell me some of the other challenges and other considerations that we should be thinking about as the Senate is processing the House tax bill.
Happy to do that, Mike. And, as I sort of referenced earlier, the House had a much more restrictive budget constraints on the reconciliation when it was being considered in their chamber. In particular for tax purposes, there was a net $4 trillion that the reconciliation instructions allowed for on tax issues. And while it seems like a really big number, Mike, when you consider how how much it would cost to make the Tax Cuts and Jobs Act permanent, was well over $4 trillion, not to mention accommodating the President Trump's tax campaign promises. It really demonstrated how stringent that net $4 trillion limitation ended up being. On the Senate side, they have less of a limitation. They were, and again, I'm not going to get into the arcane details here, but to simplify the situation, they were allowed the use of what's called a current policy baseline, which essentially assumes making the Tax Cuts and Jobs Act permanent will not have a score for purposes of the reconciliation legislation. And that, on top of that, they could accommodate $1.5 trillion of new tax provisions. And that provides a lot more space for the Senate version of legislation, and why we think there's a better opportunity for things like a new markets extension or restoring tax credit provisions, or loosening up some of the restrictions on the renewable energy and clean energy side. So we'll see how this process goes forward, but I think that's why we have some confidence that the Senate will be able to make some changes.
And I'll also build on your point about the current policy. And you've heard me say this many times before, Peter, at various sessions at our various conferences, that the current policy approach that Chairman of the Senate Finance Committee, Mike Crapo, has wanted to use is all about budget reconciliation scoring. And I mentioned earlier that as part of the budget reconciliation process and clearing the parliamentarian, something has to have a revenue effect, and that revenue effect can't be incidental to the policy. And then over a 10-year period, you can, run up the deficit. You can have a net cost over a 10-year period, but in the out years, you can't have a negative impact on the national debt. You can't be running a deficit in those out years. And the question becomes, how do you measure those out year costs? And the current policy basically says that you're measuring it against current policy, so that in the out years, if you made the Tax and Jobs Act changes permanent, they by definition wouldn't have a cost in the out years, because they would be measured against them being permanent. And there's other parliamentarian issues around that, which I'm not going to go into here, but the whole concept of the current policy baseline is so that the TCJA tax cuts can be made permanent. And whenever I say permanent, I should be saying indefinite. They're only, because one Congress can't bind another Congress. So it's a question of what future Congresses might do. And then when you mention that the Senate is less restrictive with it has kind of, quote, more money to spend, that doesn't mean that once they do that, the House will accept it. So then the House will then have to figure out, between the House and the Senate, what can stay in and what will stay out relative to what the House passed and what the Senate passed. I don't want to go into all those machinations, but I will just remind everybody and get your comments on this, Peter, that back in 2017, towards the end of the discussion about the passage of the Tax Cut and Jobs Act, there were, there was a lot of surprises, but one surprise was some changes to the ACA that generated a lot of revenue. That then allowed for the corporate tax rate to go from 25 to 21 and other changes to be made. So I do wonder in the Senate, as we're working through this process, what changes might be put in that generate revenue such that they can pare back and get less revenue from paring back renewables and the like, put in new markets and some historic tax credit provisions, all the rest, but not diverge too far from what the House did. And just as I was thinking about that, Donald Trump last week sent out a tweet that talked about potentially privatizing Fannie and Freddie in a more accelerated schedule, which would generate a few $100 billion potentially. There's also the potential, and I'm not necessarily saying that'll happen, but that's an example of one of these sort of surprises that I've been thinking about. I mentioned earlier that CSAL, corporate limitation, deduction limitation of state and local taxes, maybe that makes its way back in the Senate bill as a way to bring down the net cost. Any other thoughts about some of those machinations as we bring this towards a close?
Well, the one thing we are expecting also, and this is going to be one of those tight balancing act issues here, is that one of the key provisions in the House bill was an increase on the individual SALT, right? For those who may recall, there's a cap on the Tax Cuts and Jobs Act of $10,000 for both single and joint tax filers. The House bill does increase that up to 40,000 for families under a certain income threshold. I very much expect the Senate to change that, given that there isn't that same constituency among Republican senators as there is among blue state Republicans in the House, which were crucial to get that necessary 215 votes to pass it. So that'll be interesting to see how dynamic plays out when the Senate considers legislation.
So thank you, Peter. We obviously could talk a lot more about this topic. And I do suspect I'll have you back sometime over this summer for a follow-up podcast on what's happening with respect to a reconciliation bill. I will share your email address in today's show notes for those that want to reach out to you. I'd also encourage, if folks have questions, just send the questions to cpas@novoco.com. If you don't want to send it to Peter directly, also feel free to reach out to me on LinkedIn or on Twitter. My handle, coincidentally, is @Novogradac. Peter and I will both be in DC next week. Peter's always in DC, but I'll be in DC for our spring New Markets Tax Credit Conference, where Chairman of the Ways and Means Committee, Jason Smith, will be keynoting on Thursday. There's time to register still, so please do so if you're not already registered. I'll share a link in today's show notes. Also, I encourage our audience to subscribe to the podcast on whatever platform you prefer. And please do share the podcast with your colleagues who may be interested. And those of you watching on YouTube, in addition to being able to reach out to me at Novogradac on Twitter or my LinkedIn, you can also post a comment or question on the video. Additionally, we do have a full archive of all of our prior episodes on our website at novoco.com. Okay, Peter, we're now in our off mic section, and this is an area that our regular viewers know is an opportunity to give a shout out to someone working in one of the many areas we focus on at Novogradac. We get to highlight a professional who deserves recognition. Peter, who would you like to give a shout out to this week?
I'd like to give a shout out this week to Heidi Yarmit, who is the president and CEO of MoFi, one of the leading CDEs, especially and big presence in Senate leader on new markets, Senator Steve Daines from Montana. She also was fairly active in Idaho, where Senate Finance Committee Chairman Mike Crapo is from. She has been really lighting a fire on grassroots advocacy efforts to get the Senate to include a new markets extension. Not only including CDEs, but also the underlying businesses that receive the new markets financing. That's been a great effort. We need all the efforts we can get in this crucial time period to help encourage the Senate to include a new market extension. So I want to congratulate and thank Heidi for her leadership in this advocacy work.
Thank you for that. Great choice, particularly for this podcast. Let me extend my thanks and appreciation to Heidi Yarmit for all the work that she is doing to see that the new market tax credit gets extension at a minimum permanency, hopefully in the Senate bill, and then is successfully passed and signed into law by President Trump. Peter, thank you for being on the podcast today.
Thank you.
And to our audience, I'm Michael Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.